with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come, trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, April 4th, 2025. Ton of shout outs, man. Shout out to Jody, Brian, Ray, Aaron, Rip, Frank, all the folks that are tracking with us on social media and Facebook and all that sort of thing. Hey, we just appreciate everybody tuning in and staying up to speed on what is going on with you and your money. And that's why we're here doing this today. So let's go ahead and jump into it. Look, before I even get started, let me just say this, okay? Because it was just a hellacious week on Wall Street this week. One of the worst I've seen in my career. You just don't see the market drop this much this fast. It's really shocking. We'll talk all about it here in just a moment. But let me let you know this. We're doing great. We are absolutely doing great. You know, almost all of our models were positive on the year as of Thursday, and they just barely dipped into the red here on Friday. The most aggressive models are down just a couple percentage points more, not much. But let me tell you something. The S&P 500 is down 14%. The NASDAQ's down 19%. And we just barely broke below flat on the year as of today. I mean, just today alone, the S&P was down 6%. We were down half as much. So let me just tell you, you're doing fine. And I'll tell you why in a moment, but you're doing just fine. So take a deep breath. I know a lot of stuff's going on. There's a lot of fear out there. Take a deep breath, relax, because you're doing okay. So let's talk about the markets. They're not doing so okay. Dow Jones down 7.8% on the week. The S&P 500 down 9% this week. The NASDAQ composite down 10% this week, and the Russell Small Caps down 9.6%. Taking a look at the volatility index, as you might expect, it just was right up through the roof this week. It just was off the chain. It was up 109% on the week. It was up 50% just today. VIX exploding up at around 45 on the VIX. We'll talk about that too. Long-term bonds as measured by the TLT, they were up 3% this week. So long-term bonds doing their job, providing a little bit of a cushion there. There's no need to really go through the sectors because they all got decimated. The only thing that didn't get decimated this week was consumer staples. That's soup and cereal, right? Your food and soap and toiletries, things like that, things that people need every day. You might recall we were talking last week. I said one of the things I didn't like was that the defensive areas of the market like utilities and consumer staples had not rolled over yet, but they will. If we're in a bear market, they're going to eventually cave. Well, staples caved today. Here on Friday, they were down 4.3% on the day. They did finish down 2.5% on the week, but we finally started seeing the defensive areas of the market give up the ghost, and they really started to get hammered as well. No need to go through all the details. They're all down, and all down a lot. Gold was only down 1.5% this week. Silver, which is a lot more industrial uses, down 12.6% on the week. It got hit very, very hard. Okay, so I know you've not been living under a rock. You know what's going on. But let me just tell you about what's going on with your money first. You recall last week, I was talking about the month-end indicator that I follow so closely. And I said Friday last week that it would take a miracle for it to get back above that line in the sand by the end of the day on Monday. I did not think it was going to happen. And come Monday in trading, it was clear it wasn't going to happen. So I started selling on Monday. And man, did we sell. I sold quite a bit of stuff on Monday, and I sold a whole lot of stuff on Tuesday. Between the 2 days, we raised up approximately, depending on the model, about 20% in cash in those 2 days. So, we sold Bank of America, Devon Energy, Diamondback Energy, the S&P Biotech Index, Comcast. I trimmed CrowdStrike, Shopify, cut them down, cut a third out of those. I trimmed the gold investment, right? Look, we had Kinross Gold. It's been on fire. It's been doing great. Well, we sold on Monday at $12.60. It finished the week down 5.6% at $11.80. I just trimmed everything. I just sold like crazy, like a madman. We really took a lot of money out of the market between Monday and Tuesday. And the market was stable both those days. Things were actually going okay. But that month-end indicator broke. And I told you, I talked about it in the newsletter. I talked about it on the podcast coming into this year. We were not going to monkey around this year. I didn't trust the market coming into this year. Look, I thought middle of last year we were headed towards a recession. And then when the election happened, the market ripped higher. I felt that the wealth effect created by the market coming up so much may be delaying recession to 2026. But nonetheless, I thought the market was expensive. I didn't trust it. And I said, we're not going to play games. If the indicators fail me, I'm going to set my opinions to the side and I'm going to react accordingly. And that's what we did. We raised up a bunch of cash. And then came Wednesday. And Wednesday afternoon, 4 p.m., President Trump announced the tariffs. Now, look, folks, a couple things. First of all, after I raised all the cash, I contemplated putting on a short. I thought about shorting the market. Shorting the market is when you can make money on the market going down. As a matter of fact, 1 for 1. Market goes down 1%, you're up 1%. I thought about taking that 20% in cash and shorting the market. But, I was talking to folks there at the office, Daniel and whatnot, and Christina and everything, and I said, look, here's the problem. This tariff issue is a binary event. It's just too binary, right? There is a 50% chance that the market was going to like the tariffs. And if it did, it would have ripped higher, folks. We could have easily be talking about a market that was up 10% on the week instead of down 10% on the week. And if that happened, the short would have just blown up. It would have gotten its teeth kicked in. I didn't want to go down that road, right? So we just kept the money in cash. I didn't short the market. That might change going forward. We'll talk about this in a minute. But anyway, the announcement came out. And folks, I'm going to tell you something. These tariffs might be a lot of things. Reciprocal is not one of them. I'm appalled. I'm shocked. My mind is blown at this Mickey Mouse mathematics that this administration used to come up with these tariffs. And look, I know I sound pretty harsh. And listen, let me tell you something. I fully support coming against every country around the world that's been taking advantage of us for decades. Because they are sticking it to us. Make no mistake about it. They're sticking it to us. And it needs to be fixed, okay? I champion that idea to fix this. I also champion the idea of scaling back government. It's overbloated. Everybody knows it. It's disgusting the amount of waste that's happening there. It needs to be streamlined and trimmed down and made more efficient. I support these efforts. Absolutely support them because we need to. We're broke. We are broke and it's getting worse. We have to fix the debt spiral that we're in. Okay. That said, this is insanity. These tariffs were absolute insanity. I'll give you one example. Let's take Vietnam. Okay. Under the first Trump administration, we all came to the realization that America and China are no longer friends, right? And not only did Trump put tariffs on and kind of start some back and forth with China, the Biden administration maintained those tariffs, right? And maintained the same footing that Trump began in his first term. So what did companies do? They did what was asked of them. They got out of China. They took their business. They shifted their supply chains to places like Indonesia, Malaysia, Vietnam. They spent billions of dollars to set up new infrastructure and facilities. They trained Vietnamese how to sew shoe soles onto sneakers and how to make bad furniture and all kinds of stuff like that. Okay, that's what they did. Now, just so you know, Vietnam has a tariff against United States imports, stuff that we're sending to Vietnam. They've got a 5.1% tariff. 5.1, okay? Do you know what tariff we put on Vietnam? 46%. 46%. Now, let me tell you how they came to this conclusion, how they got to this math. They didn't look at the percentage of tariffs. What they did was they went throughout the world and they looked at the trade deficits. How much money in goods and services is Vietnam sending us, and how much are they taking from us? They took the numbers, $136 billion Vietnam sends the United States of America annually, $136 billion in goods. And they're taking $13 billion, okay? It's a small, poor country, folks. Their GDP is only $400 billion total. That's their whole GDP. And we're 40-some billion dollars of that. Anyway, they took this difference and they said, well, golly day, they're only taking from us 10% of what we're taking from them. That's a 90% difference. We should put a 90% tariff on them. But you know what? We have a heart. So we're going to cut that in half and we're going to make it 46%. What kind of mathematics is that? How in the world do you call that reciprocal? You can't expect a small, little, tiny country with $400 billion of GDP to spend the same amount of money with America, whose GDP is $4.5 trillion. I mean, come on. That is insanity. And it was across the board that way. And you know what? The market reacted accordingly. It absolutely crashed. It rolled over hard. Wednesday night, the futures just absolutely plummeted. That carried right into the day on Thursday, and it even worsened here on Friday. Now, a few things, folks. I told you maybe last week or the week before. I said, I think the Trump administration wants a recession. And I knew it was going to be controversial to say so. But understand something. There's a couple really big things they want to see happen. They want to see the 10-year yields come down. And guess what? It came down this week. It came down hard. In the middle of January, the 10-year Treasury yield was 4.8%. We finished the day at 3.8%. It's come down hard, which, by the way, let me just pause here. If you've gotten a mortgage in the last couple of years, if your kids have bought homes in the last couple of years and they're dealing with these 6.5%, 7% mortgages, now's the time to keep your eyes peeled, okay? Keep your eyes peeled. Rates are likely going lower, and we could probably see mortgages in the 5s sometime in the near future. So just keep your eyes peeled for that. Keep watching for that. Anyway, I thought they were just open to having a recession. Now I'm starting to think they're trying to actually cause it. And I'll tell you this is going to sound crazy to you, but I saw with my own eyes. I don't subscribe to the social media platform, but it was sent to me and I went on and I looked at it, saw it with my own eyes. President Trump posted on social media, he reposted someone else's message that said, Trump is playing chess while everyone's playing checkers. He is trying to crash the market to bring down interest rates so America can refinance its debt. President Trump reposted that message to his social media account. I think this is the game plan. And if you listen to Scott Bessent, the Secretary of Treasury, look, I've told you guys, they've been talking about pain. Stay, bear with us. We're going to be some pain. It's going to be a rough road. Bessent just continues to harp on the 10-year yield. They want it lower, lower, lower. And look, they're not going to get it from Jay Powell. Jay Powell spoke this week. I think it was this morning. And expect no help, folks. Expect no help from the Federal Reserve. They are in no way interested in lowering rates anytime soon. It's going to come. Their hand's going to get forced. They're going to have to lower it if the economy continues to deteriorate. But at this point in time, they have no inclination whatsoever to lower rates anytime in the near future. They're concerned about the inflation aspect of tariffs. And look, there is going to be an inflation aspect of tariffs, but keep this in mind. That's a one and done. It's going to push prices up higher suddenly, and then that stops. It's not as ever escalating situation. But I do not see the Fed cutting rates ahead of that. I want to see that pricing adjustment happen before I think they start to contemplate cutting rates. So you have no protection from Jay Powell, and you don't have any protection from the Trump administration. They do not care about the stock market. They've come right out and they have said it. So hang on, right? Now, I told you coming into this year, told you middle last year, I thought recession was possible in 2025. I changed that outlook to maybe 2026. That's off the table now. I think we're heading into it. I really do. I think my base case right now, my expectation is that recession hits us this year. There's too much fear. There's too much throttle on back, way too much uncertainty for corporate America. And you look at the sentiment indicators and everything else, I just think that it's almost a given that this is the direction we're heading. We're going to head into a recession, in my opinion. Okay. Now, what does that mean? It means this. The market's down 17% from its high right now, down 14% on the year. And you think, oh gosh, it's been horrible, David. Oh, it's been a bloodbath. It's been terrible. The market's just awful. So it's got to be close to being over. And you know what? A lot of folks are thinking that. Do you know retail flows? That's folks that are doing it on their own, regular individuals that are buying stocks in their accounts. retail flows were through the roof on Thursday. People were buying stock. Retail investors are buying stock. Markets won't finish going down until the retail investor throws a towel in, okay? Retail investors usually always last to the party. So what does that mean? It means the market can go a lot lower. When you have a recession-driven bear market, you need to expect the S&P down not 17% from its high, but 35 or more, 30 to 35 at the minimum, and maybe a bit more than that. So if that's where we're headed, this may just be now getting started, okay? It just may now be getting started. So again, the good news is you're hardly down at all right now. You're down like a couple percent at the most, and the market's down 14 year to date. So we're in a really good position where we sit at the moment. But I do think that recession can unfold. I think the market can experience a lot more pain. Now, a couple of things. Normally, recession bear markets don't start like this. It's not a cascading waterfall. It's usually just starts to roll over and work its way down. This looks like COVID. It looks like Brexit. It looks like a shock to the system that can turn around and rip right back again. But listen, the tariffs are just one part of the story. There's weakening economic data. There are big layoffs going to be taking place within the federal government and a reduction in spending. There's tons of uncertainty. There's just too much to expect this thing to turn on a dime and rip higher. That said, it will rip higher because the biggest rallies you will see in your life come in the midst of bear markets, So let me just give you an example. So like one day next week, maybe there's a deal with China and TikTok. Maybe there's a easing of tariffs with some of our trading partners. And this market can turn and it can be up 5, 6, 7% in a day or in a few days. And you're like, whoa, it's great. It's over. It's all sunshine and lollipops. And retail investors will continue to get caught up into that. And then the market, it's very cruel. It will beat them over the head with a club and go right back down again until they finally give up and nobody wants to buy anymore. That's how it works. Big rallies, they get shot down hard and nastily, and eventually everyone just throws in the towel and they give up. Okay, they don't buy, they just stop buying altogether. So I'm just laying out what these things will look like if that's where we're headed. And there's nothing for certain says that's what's going to happen, but I think the odds are extremely high right now. I put them north of 80% that we're going to slip into a recession. So what's the game plan for BIG, right? Here we are, we're sitting pretty, right? We're in really good shape. We haven't gotten punched in the face like everyone else has. So what do we do from here? Well, it depends on the scenario. We're sitting on this cash. I talked last week about the hedges that I was looking to put into place. Look, I had more meetings this week with some of the top hedging strategies in the country. I had meetings last week, meetings this week. There's a couple of things that I absolutely love in the alternative space that I do plan on adding to the models at some point in time. But here's the problem. The market has gotten hit so hard, so fast, 10% in 2 days, that I no longer want to put these hedges on because these hedges are not directly opposed to the market. They're not shorts, they're hedges, and they're down now too. And right now, there's so many opportunities in the stock market, and I got all this cash on hand. I think we can make more money doing some buying, okay? Some really purposeful and well thought out buying. So I'm not ready to put those hedges on. So here's the game plan. One of a few things are going to happen. More bad news will come this weekend. There'll be more retaliatory tariffs. China put on 34% tariffs overnight. That's why the market had such an ugly day today. If more of that happens over the weekend and there's no capitulation from the administration, then folks, you could see a crash like we haven't seen since 1987 unfold at the beginning of the week. It's a possibility, right? You could see an absolute bloodbath kind of day in the market where the circuit breakers are kicked. What does that mean? It means the selling pressure is so intense that they actually shut the market down throughout the day, trying to let people cool off and calm down and keep their heads about them. If that happens, we're buying stock, okay? Because that's just, you got to buy fear like that. Go all in. I won't be doing that. I'll be working hard all weekend long, dotting the I's and crossing the T's on our buy list. And if we get that type of horrific move on Monday or Tuesday, something like that, then I'm going to do some buying, okay? Let's say that doesn't happen. Let's say the market stabilizes. Let's just say it just stabilizes. We're sitting on all this cash. I'm going to leave it in money market, getting us some yield, 4% or whatever in money market, And we're just going to be patient because, as I said, recession-driven bear markets go down twice as much as where we are right now at a minimum. I'm not ready to buy yet, folks. Things look broken to me. Okay, third scenario. We get a real strong bounce. That's probably going to happen anyway. We get a real strong bounce in days or weeks to come. If that happens, I am contemplating putting a short on the market because, again, I think things have deteriorated to a point where it's more pain to come. Look, we blew through every level of support that the strategists that I deal with some of the top technical folks out there, folks you see on CNBC. I've been communicating with them all week. There are levels in the market of support at 54.80 actually, then another one down at 5,300, another one at 51. We blew through all of them. We blew through all of them like a chainsaw through whipped cream. Forget knife through butter. A chainsaw through whipped cream. The market just slid right through them like nothing. That's not good, okay? And I think there's more downside. So if we get a big bounce, I will probably entertain putting on some sort of short or hedge that will do some shorting against the market so it can profit with the market going down further. So those are the three things that we're watching. Major crash. David, haven't we already had one? No, not really. Major crash, maybe beginning of the week or something like that. Stabilization. We've got a game plan for that. Strong bounce, real strong bounce. Then I'll probably be looking to put on a short unless something materially changes. I may or may not do that. That's tricky business, right? You got to really have a high degree of confidence that the market's going lower to do the shorts. You have to be a little bit careful because we don't want to miss out on return either, right? The market starts going up for good. We don't want to be sitting there with a big short on the market. So we'll be paying real close attention to that and discerning that very, very closely before we make that decision. But the bottom line is this, folks. The bottom line is this. You're in good shape. You're in good shape. We raised up tons of cash on Monday and Tuesday. Let's even back up further. We took tons of money out of the U.S. stock market on January 3rd. We sold all kinds of stuff on January 3rd because I didn't trust the market. And we shifted a lot of money overseas, which has done very well and held up much better year to date. And then on Monday and Tuesday, we raised up a ton of cash. So we got bonds, we've got cash. I think we're in great shape. Not that it's not going to be painless. There's still going to be a little bit of pain, but nothing like what the market's dishing out right now. And I'm happy about that. I'm glad we're in this position. So don't fret, don't fear. Got it under control. We're on it. We'll be burning the midnight oil here over the weekend. We've already enacted phase 1 of the game plan, right? Get money out, cash. Now it's time to implement phase 2. When do we want to start making some moves that can benefit us moving forward? And how much do we want to brace for a potential recession and much bigger decline on the market? Okay. You know, like some folks say, David, why don't you just sell it all on Monday and Tuesday? Put it all in cash. Because that is like the dumbest thing that investors could ever do is to sell it all. Do you know if you take out just the 1 or 2 best days of the year out of the stock market, if you just take that out of the equation, it cuts your returns down like more than half over the long run. You just don't do that. You don't gamble. We are investors. We're not gamblers. We're not going to gamble with your money by going all cash. We're going to be smart and prudent, right? We're going to pull money out when things look risky, and then we've got that cash ready to buy when things look more attractive. We don't sell it all and go run in a rock because guess what? On Monday or Tuesday, if I did that and those tariffs that were announced on Wednesday, if they were truly reciprocal and not crazy town, this market could be up 10% today and not down 10. And then that would have been horrific for long-term performance. That's why we don't gamble with your money. All right, I've gone long, I guess, but hey, it's important. A lot of stuff happening. Be comfortable. Don't be stressed or fretting out there. We got it under control. Keep tuning in, okay? Also, be on the lookout for the newsletter. We're going to be getting that out there this coming week. I've been a little busy. Didn't get a chance to finish writing it yet. All right? So between now and next week, you're thinking about your future long-term goals, all the things you want to do with you and your money. Maybe it is retire a little early, buy that second house. Hey, talk to a client this week, buying a beach house. Good for you guys. I'm pumped for you guys. Now you can get a better interest rate. Hey, you know what your goals are. Don't just think about it. Think big. Think B-I-G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.